welcome to SFI Not So Live. It's November 2023 and a year on since we covered this subject before with our very special guest of today. So before I do introduce our special guest, let's just quickly introduce our stalwarts. Tony, I'm going to come to you first for a little quick introduction for any new listeners, please.
Yes, thanks, Jay. Hi, everybody. My name is Tony Hall and I am Head of Business Development here at Saffron. So my role really is focused on ensuring that our intermediary partners get all the support that they need in order to help their clients and help us.
Fabulous. Thanks, Tony. And Phil, welcome. A little introduction for you as well, please.
Hi, Jay. Yeah, I'm Phil Lawford. I'm Saffron's National Account Manager. I spend most of my time looking after key broker relationships. So I spend a lot of time with mortgage intermediaries and talking to them.
Wonderful. And just before I introduce our special guest, I'm just going to reference why our special guest is here. So a year ago, we're on our anniversary in a couple of months of the disastrous mini budget that had quite an impact on our markets. So I am very pleased to say that we, a year later, are going to have a little look back over the last year in our first year of Rishi Sunak and see if things have stabilised and got a little bit better. So, Ray Boulger, welcome back to the podcast 1 year later. Quick introduction to the audience, please.
Good to be back, and thanks for inviting me. Just to update people, I've, as many people know, been with John Charcoal a long time now. I joined John Charcoal in 1989. Having previously worked in the stock exchange and as a stockbroker, and I've now slowly traded down, and I'm now part time at my extended age. And as long as I continue to enjoy talking to people, looking at what's going on in the market, and John Charcoal think I add value, I'll carry on.
Cool. Thank you, Ray. It's really good to have you back with us. And you might be advancing in age, but certainly in experience, you can put a lot of us to shame. So thank you very much for joining us. So as I said, quick caveat first, this has been recorded on the 30th of October, 2023. So some of the rates and items that we discussed may be slightly out of date by the time you listen to us. So I'll go back to what I said a little while ago. We're looking back on the last year. So we're officially a year of Rishi Sunak in government, and Liz Truss has bogged off. I'll get everyone's opinion on that in just a second, but we're here to review the last year. We all know the effects, some of us quite personally, as Tony will talk about later, I'm sure, of what happened after the mini budget in 2022. And, now a year on, how are things going? What does the market look like? The markets look like, but what does our sector look like? And, maybe we can have a little prediction on what might happen over the next few months, especially as we've got a Bank of England decision in just a few days' time. So, first of all, Ray, I'm going to come to you as the fountain of knowledge. And just for a little summary of what you think the last year looked like based on, what happened during the mini budget. Maybe just for the sake of those that might not have listened to last year's podcast for quite a while, just explain what the mini budget did to the markets and how that has had the impact it's had now, if you don't mind.
Okay, well, I think the main reason the mini budget spooked the markets was that despite proposals to significantly decrease taxes, with the suggestion from the then Chancellor Kwarteng that there would be further proposals for tax decreases, there was no corresponding suggestion at the same time as to how money was going to be raised. So the market saw this as a massive increase in borrowing, probably to the tune of 50 to 75 billion, and on top of a government balance sheet that was already not looking too clever after the QE of COVID, etc. That just completely spooked the market. Gilt yields shot up, and that, of course, meant that lenders not only had to pay a lot more money for whatever money they wanted to borrow to lend on fixed rates, but because the market was so volatile, it was really difficult for lenders to actually know price their products. So we actually had a period of several weeks where it was virtually impossible to get a mortgage above 85% LTV. Same situation applied after the global financial crisis and after Brexit. There were periods of time when 95% LTV mortgages disappeared. But now obviously the market's pretty well back to normal. I think the emergence of a new chancellor who very quickly changed tack really helped the market to recover, but it took, of course, several months. Having said that, by early this year, interest rates had fallen back quite sharply. And so we were then able to actually start looking at slightly more sensible mortgage rates. And I think over the last few weeks, we have seen rates come down, which obviously, gilt yields come down, which obviously has resulted in mortgage rates coming down. And what that tells you is that the market is getting more and more confident that bank rate is going to peak at 5.25. So we've got the bank rate decision later this month. Later this week, I should say. Expectations are that both the Fed on Wednesday of this week and also the MPC on Thursday will keep rates unchanged. And I think the key question now is not have rates peaked, but how long are they going to stay at this level? And when they start falling, how quickly will they fall? But I think the fact we have seen, in particular, shorter-term gilt yields, the 2-year gilt yield, fall quite a bit over the last few weeks, does suggest the market's getting a bit more confident that rates may start to fall, perhaps a bit quicker than some economists expect. So my best guess at the moment is
there's some politics at play here as well, though, isn't there? Because we are coming up to a general election year. We've got, you've mentioned, we've got a new chancellor in, obviously since Kwarteng disappeared, who has been a bit more sensible. We've kind of got adults in play here, but we have the potential of a general election coming up. Inflation really hasn't dropped as many would have perhaps predicted it would have done. It's not gone down as low as it could for other factors, obviously, and we'll talk about the cost of living in a bit. But do you think, is your prediction then that come the second, it's the second, isn't it, that they're meeting, that the Bank of England will keep the base rate as it is?
Yes, I think it would be very surprising if they felt the need to push bank rate up further. The news we've had since the last MPC meeting is positive in terms of keeping rates unchanged rather than pushing rates up. The next key figure to look for is going to be the inflation figures, which are due mid-month. And the expectation is they'll fall from 6.7% to around 5%. So a large part of that fall is already baked in because some of the big increase in oil prices that took place a year ago falls out of the year-on-year equation. So it looks like at least that one of Rishi's 5 targets will be met well before the year end.
I've not heard about that in inflation, so that was a positive thing for me to hear. That's for sure. So that's good to hear. So Tony, the last year, it's been a year since we did the last podcast. I'm going to ask you about your mortgage rate later, so don't talk about that this bit. But just summarise how the year was for you as a lender. What's it look like, and how's it been for the brokers, for borrowers, and for yourselves to manage? Because it did really kick everyone up the butt, didn't it?
Well, look, it's been a tough year for customers and brokers and lenders to a degree. The volumes haven't been there because the main thing is the affordability, obviously, affordability and a rather benign house price or house purchase market. The results today have shown that whilst there's a small bit of growth, it's only 10% of what it was a year ago. It's 1.1 in October, I think, HPI, and it was 9.6 this time a year ago. So I think that says it all. House prices are dropping because people can't afford to borrow as much and therefore can't pay as much. So the hardest thing, I think, has been for lenders when rates were going up was to price products appropriately, but to support brokers and customers with affordability at the same time, because the two don't necessarily go hand in hand. So the positive is you've seen lenders starting to consider other ways to support affordability rather than just interest rate. So you've seen using of the loan to income caps, looking at people extending those, looking at how affordability is calculated in better ways. So I think it's been a year where people are looking at how to support, because we still need to get the volumes that we need to get. So from that side, it's been positive. Obviously, at the moment, rates are dropping, and as Ray said, look, all the markets are anticipating that it's not going to go up further. But I think rates are primarily dropping at the moment because of a race to finish the year off and get the pipeline for 2024. That's the key thing. With like Skipton on its own reduced over 100 rates last Friday, I think it was, across their portfolio.
Wow.
The bigger lender you are, the more products you've got. So it's a nice article. But we've reduced a lot of ours. We look at it every day to see where else we can support. So it's been a very, very strange year and an interesting year. Lenders started off the year not getting the volumes they want. They're now trying to pick them up. For us, though, who's not really, we're not a volume play. We're a specialist, more complex income, complex situation lender. We've actually seen ours improve because more people are requiring a lender that can take that common sense view. And it's an overused word, but that's what our lending policy allows us to do. And in these challenging times, that's what's worked well for us.
That's understandable. Phil, let's talk about it from a broker perspective. You've worked many years working with brokers and got great broker relationships. It's been a tough year for them too. But also something we discussed, and anybody who listens to podcasts regularly, there was a lot of media stirring, pushing and frightening that made borrowers a little bit scared, which made the brokers' jobs harder. So, your summary of the last year and including some of those elements, perhaps.
Yeah, I mean, sort of similar to Tony and Ray, it has been a real roller coaster of a year. I think probably brokers who were perhaps more in the purchase end of the market, transacting purchase mortgages, were probably more adversely affected. Broker firms have got good relationships with their existing client base and work those will have always done better, because I think the market this year has been predominantly propped up by refinance rather than purchases. So we've seen certainly saw the pendulum swing over the last 12 months. So for me, that's probably been the biggest change there in the market. And yeah, I think next year is going to be a tough year as well. And what the markets need is certainty more than anything else. So I know you mentioned there's going to be. No, we're pretty certain it's going to be it's highly likely to be an election year next year. I think from a market point of view, we want lots of certainty and boringness, really, not spook the markets too much, which will make everybody's life, certainly brokers' lives in the market, a lot easier. If we've got an idea of what's likely to happen, then we're likely to see rates stabilise and hopefully see some confidence there back on the purchase side of the market.
Well, since you've just left us on a bit of a politics note, Ray, I'm going to come to you on a politics note before we move on to just talk about mortgages and mortgage customers. So, Labour Party conference, quite a pat on the back for our looking like potential Chancellor. Do you rate her? Do you think her Bank of England-backed history will give confidence for the markets? Do you think she's got an opportunity as the first female Chancellor to make a difference? Or do you think she'll spook? Or do you think Labour will spook?
Well, so far she's talking the talk. She will probably get an opportunity to see if she can walk the walk as well. I think one of the positives of the general election is that because both the main parties have fairly similar policies in terms of economics. Labour pretty well said they're going to follow Tory policies. Actually, unlike some previous elections, we don't really have to worry too much about who's going to win. I mean, clearly it would be a major surprise if Labour didn't at least have the largest number of seats at the moment. But I don't see that spooking the market now. So I think Labour have done a good job in terms of preparing the market for their becoming the party of government. But I think one always has to reserve judgment until you see what they deliver in practice. The first year, we pretty well know what they're going to do. We need to see a full 5-year term. In particular, Their housing target, I mean, they've said they want to build 1.5 million houses in the 5 years. Now, clearly, that's going to be focused more in the later years, because this year's housing completions are probably going to be the lowest for many years. So the starting point, because next year is likely to be weak as well, is going to be very low. And frankly, I would be amazed if Labour have any more success in achieving their target of 1.5 million over 5 years than the Tories have of achieving their 300,000 target. Now, everybody talks about the need to build more houses, and we all know that's necessary. But what people tend to forget is that when there's a downturn in the market, builders immediately slam the brakes on. So we saw in the last quarter of last year, all the new housing developers cut back their starts substantially, which is why housing completions are going to be low this year, and they'll probably be pretty low even if they're a bit better next year for the same reason. So what we really need is not just a change in the planning rules, which clearly is a problem, but also some mechanism whereby when market demand falls because of a change in the economic situation, there is some mechanism in place through either local or central government whereby builders can be given contracts so they keep building, and therefore we can maintain the flow of new properties at the same level rather than having these sharp movements whenever there's a change in the economic situation.
Great insight. Okay. So, funnily enough, house building and housing does come up a little bit later on. So let's we'll park that for now. But that's a really good sound insight. Okay, so just one last question for me, Ray, before we move on to mortgages on the markets. They've all come down. Is there any long-term impacts away from the mortgage market, away from the property market? Is there any long-term impacts that we've seen that in the last year that haven't improved after the turmoil of last year, or are we now seeing a sort of return to some normality and stability across the board?
Well, I guess it depends how long-term you're looking at. But if you're really looking at long-term impacts, I saw some interesting stats the other day suggesting that in 50 years' time, there are large parts of some of our coastal cities that are going to be underwater. So I think, particularly bearing in mind we're getting more and more mortgages for 35 and 40 years, that poses an interesting challenge for lenders, and properties in areas that are subject to flood risk may well become more difficult not only to insure, but more difficult to perhaps mortgage as well. So there are some really challenging questions, I think, that everybody in the housing sector needs to look at, so that we don't suddenly come up against a problem that could have been foreseen and hasn't been adequately prepared for.
Great insight once again. Okay, let's pop over to mortgages. So that's what we're here to talk about, really. So we were talking just before we pressed record, and we perhaps should have saved this because we were getting quite passionate about it. So see if we can get the passion back about it. Right to the start of our podcast of November last year, the first thing we said was the rates are coming almost near 3%. So, you could hear the shock on our voices that they were coming even close to 3%. Certainly rose above that slightly. Tony, I'm coming to you personally on this one because I'm going to quote you. You literally said, we're all in this together. Your fixed rate come up last year. Go on then. How did it impact you? What sort of kick in the guts did you get? Because you literally said it was coming up in the year, this year just gone. So you must have felt some personal impact.
I have. My mortgage is split between fixed and tracker, so I've had the worst of both worlds. So I've seen a tracker rate go up 14 times in the last year, and my fixed rate, which I was on at, I think I was on at 3 something because I've got an offset. I'm now at 576, I think it is. So that's the impact. So the impact for me is about £1,000 a month increase on my mortgage repayments in the last 12 months. So, look, I'm in a fortunate position that I can cope with that. If you couldn't, then God knows where, and how people are feeling who are in this situation. So, but as I think people tend to forget, it's only a problem if your fixed rate's coming up. And there's only a certain cohort of the UK whose fixed rates have matured at this point. So I know a lot are going to come next year and they are going to have payment shock, but don't panic about it until, that it's inevitable that that's going to happen. And you've got your broker and you've got your lender who's going to help you through that. But it did create a lot of panic last year when a lot of people didn't need to.
Well, that's what I sort of mentioned earlier with the media panic. Everyone went into meltdown thinking absolutely everybody's mortgage is going up. If you listen to the news, honestly, you'd have thought every single person who had a mortgage, it went up by a minimum of £500, £500 a month. It was just overhyped, and it was pushed, and it was politically motivated, no doubt. What was so, Phil? I mean, the average person, but as you said something earlier. As Tony's just said, there's only a proportion, and there's another proportion that might come next year and might get the same shock. But how much of an impact did it have? Was it a small percentage of the market? I can't imagine it was a huge.
I actually felt really sorry for brokers because of brokers were sometimes having to do 3 times the amount of work because of they were advising on the best deal at the time when rates were higher. Then we had a bit of calm in the market and rates came down, so they've always had to re-broke them or re-advise if they might have found them a better deal elsewhere, and then their product transfer came up and they were offered a better rate. So I did feel extremely sorry for sort of brokers having to do, sometimes triple the amount of work. So I think that's been the biggest challenge, and I suppose it brings us a question to us lenders: can we make the market work any better than it is, or than it has done? But I think that was the biggest impact. But brokers are most brokers are very good, and they all want to do what's right for their clients.
It's funny, actually, because, Tony, you mentioned tracker. I'll come back to you again, sorry. You mentioned that because we spoke quite a lot on the last podcast about trackers and variables. That might have been the right thing at the right time. The brokers weren't perhaps as experienced at offering those kind of products. Did you see a lot of that during the last year? Did you see a lot of people switching over and coming off the fixed rates, or did people just stick with what they knew?
We've seen a lot of people utilising discounts and trackers because when in a constantly rising market, the fixed rates will have priced that in and will be at that peak point of the market, whereas the discounts and trackers won't. So for the right client, if you can cope with that payment increase every time it increases, actually the effect of taking the fixed versus a discount that might build up to that is actually cheaper. So it's all down to the right advice for the right circumstances. So they are, and typically a lot of discounted products are, and we're no exception, are ERC free. So it actually allowed people the opportunity to not fix themselves directly into a rate, but just see how it went, but have the option to fix it when it got to their point of, this is too much pain now, I don't want to see it go any further. So they're and they always will be, a very valid tool for the right customer. It's just brokers forgot to do it for a decade.
Do you see that change? Ray, you've been around a long time, and you've seen brokers and the shift and change in the market. Do you think nowadays the brokers are becoming, do you think this year has sort of educated them on a variety of products and maybe pushed them away a little bit? Or do you think there's some element of education needed for brokers to look at these alternative products and give the right advice? How do you think the market has fared on that?
There's always a need for education because things are always changing. And as always, you'll get some brokers who are very switched on and other brokers who will be less so. So from a client perspective, picking the right broker is absolutely crucial. And I've always taken the view that the best way to find a good broker is to talk to your friends, talk to your business colleagues, talk to your relatives, see not only who they recommend, but who they recommend avoiding, because some people will have had bad experiences. But there are plenty of good brokers out there. So it's just a case of making sure you pick the right broker. And the problem with so many people is that they've got relatively little financial experience because they're not given much in the way of teaching at school. So particularly for first-time buyers, they're starting off. not necessarily knowing the questions to even ask. And this is where we get problems, for example, with people being sucked into using in-house advisors. If you're going to an estate agent, many of them will try and almost blackmail you into seeing not only their in-house mortgage advisor, but also using their recommended solicitor. If you are looking to sign a contract, which is what you're doing when you buy a property, why would you take advice from somebody who is acting for the person on the other side of the contract? And I think that's a particular problem with developers, where they'll try and steer people into using their solicitor. And that problem was really highlighted with all these horrible leases where the lease doubles every 10 years. And whilst I've not seen any facts and figures, I suspect if you actually looked at which solicitors advised a lot of those buyers, a high proportion would have been the ones recommended by the developer. And that just highlights why, if the advisor has perhaps a bigger financial interest in keeping the person who provided the business happy than their actual customer, there's a bigger risk that in some cases the right advice won't be given. So it's always challenging for brokers, but there are plenty of good brokers out there. And I suspect most of the brokers listening to this podcast will be in the category of good brokers, because it's the ones who are less good who will probably not take the trouble to listen to podcasts like this.
It's so true. That is so true.
Absolutely.
So true. And it takes us onto our education, Phil. I know this is a passion of yours. It takes us onto education of everybody, doesn't it? So it's youngsters coming through, as Ray was just saying, first-time buyers don't really understand the process of using a broker. They don't necessarily ask the right questions, know what to ask, and they'll fall into those traps. Is there anything you guys have been doing as lenders, or is the market doing to kind of really push that and drive that forward? And we talk about it so often, don't we? That, come the end of high school, we need more financial education, and people, youngsters need to understand how finance works and how money works and how the world works, but they're just not getting that anymore. Is there anything you've seen in the last year that's kind of given that maybe a kick up the butt?
Yeah, it's starting to happen now. Financial education in schools is starting to happen, not quickly enough. So I still think at the moment that the best, or the first point of entry for financial education is when they speak to a good mortgage broker. That's really where it's starting at the moment. It's not starting early enough, but we have started to see a few things happen. But there's so much more that needs to be done, starting from education in schools.
Great. Tony, just before we leave this section, I'm going to quote you again. I'm good at this, aren't I? You've said this many times before, so I just wanted you to explain it one more time again.
This could be anything.
No, it's all good. You always say the mortgage rates in the market is cyclical as it goes around in cycles, and these things happen, and it changes. We've had you just mentioned a while ago. We've had a decade of it perhaps staying a bit more stagnant than it has done before. What would you predict is the movement now? Where do we look now? If we look at the next 5 years, bearing in mind we've had that shock of last year, we're not going to get back down to rates we were before. So if you were to sort of say what the next part of the cycle might be, what would you predict?
I think let's wait and see what happens on Thursday at the MPC committee, because that will determine whether the economists have got it right and thinking that 5.25 is the top of our latest cycle, or whether it's another step up. I'm not convinced either way yet. I know swap rates kind of are, but what I am sure is it's not going down fast. That's the one thing. So we might, I think we're in a period of plateau that base rate will stay robustly until inflation is firmly under control, because the government has no other tool in its kit bag. It is nothing. That's the only thing it can do to tackle inflation, stop people spending money on, and it's not even discretionary goods. It's stop people spending money to live. So until that changes, I don't see the pressure coming off. But I don't think we're going to see rates as low as we've seen them in the last decade. It's going to be a gradual move downwards, but I don't know to what point it will stop. it's not going to go. I don't think it'll go down to what it was before. But then again, we said that in 2008, just before the credit crunch, that it would never drop that low, and it did. So who knows? Is the honest answer.
Ray, just coming to you before we move on, and anything you want to say on that in your many years of experience?
Well, just that because the dynamics of the housing market have changed so much over the years, I'm not convinced the Bank of England has actually fully reflected that in their strategy. So at the moment, about a third of all new house purchases are bought for cash. So increasingly the housing market is probably going to go that way, as more and more people, of my age and even younger, are paid off their mortgages, and first-time buyers are a bit later getting onto the property market. So that means affordability is a completely different question for somebody buying for cash. And also because, again, compared with in the 2000s, when most people had variable rate mortgages, if the government wanted to change interest rates in the 1990s and the 2000s, it had a pretty immediate impact on most people's affordability. Now, as Tony's already said, because most people have got fixed rates, it takes quite a long time, and it's going to be another 2 years or so before the full impact of these changes is filtered through, by which time we'll probably see rates falling. So the Bank of England, I think, in the future needs to think about alternative ways of attacking the economy when it needs to attack the economy, because the market is going to continue to move in the direction it's moved over the last few years, I think. And housing is really the only main area where it can affect people's interest costs, because if you've got a balance on your credit card and the interest rate goes up by 1%, well, you're paying a very tiny amount extra each month. It doesn't really have a big impact on your monthly budget. It's the mortgage. It's the only big impact, and so I think that's something the Bank of England rather needs to think about.
That's queued me up beautifully to the cost of living section, because that is a huge section we need to talk about now, because it's one of the biggest influences we've had over the last year. We've had the Russia-Ukraine conflict, which has sent fuel and food prices up. Everyone's pockets are being pinched. Everyone's struggling a little bit. Even all of us around here can feel the pinch in our pockets. It's not, nobody's been left out this time. It's not just the sort of lower end of the pay scale anymore. It's starting to hit the middle classes. We've seen some drop in energy, should we say plateauing again in energy prices, although the base rate's gone up, the day rate's gone up, so actually nobody's really seeing any benefit yet. That is affecting affordability. Tony, I'm going to come to you because you said affordability earlier, so I'll come to you first. Affordability is a big issue at the moment still. We've talked about inflation. It's showing a downward trend. I don't think that's anything the government's done. I think that's as Ray was just saying, a Bank of England mechanism. But how has it been for borrowers with regards to affordability, and what's been done to help them?
It's tough because most people's the equation for calculating affordability is pretty much linked to either a standard variable rate or some form of other metric, which obviously has been increased over the last year as lenders have put up their standard variable rates. Or if you're a lender that allows people to calculate it off the pay rate, if it's 5 years or more, those have gone from 3 to 6%. So they've doubled. So the actual mechanism of being able to borrow what you want has got twice as hard, in effect. Okay, so that's the biggest thing. People cannot borrow as much, and that's why you're seeing house prices dropping, because people can't afford to pay as much. And obviously then you've got the dreadful thing now of what was it? And I might be making this stat up, so caveated for that. I might be making this up, but a 96% increase in Gesundheit.
I saw that. I think it was 96%. I didn't realise that's that high, but I do. It's very high, wasn't it?
I think it was high. Yeah. So that's an ultimate impact of affordability, and people going, oh, hang on a minute, I could pay less for this, so I'm going to leave it to the last minute and strike a hard bargain. So affordability is tough for residential, and then for buy to let, it's got increasingly hard because the yields on the rents, The only way the landlord can do that is to put the rents up, which exacerbates the problem that we all have with cost of living. So being able to cover the lender's calculation for interest cost coverage is getting even harder. So you've seen, so we're seeing. I agree with that. Your Pooch just said that was.
Sorry,
a good
he likes to chip in at some points. He agreed with that.
Yeah, no, he agreed with me. I like it, or disagree.
No, that was an agreement, Mark. You'll soon know if he disagreed with you.
Brilliant. So for me, it's tough all round, and lenders are starting to do what they can. Funny enough, I know it's harping back, but we were the first lender to adopt a change in our stress rate rules imposed by the regulator in August 22 by reducing our stress rate from 3 to 2%. So that was one way we did it straight away. Other lenders are doing that by really looking at their affordability models or looking at their loan to income LTI caps and allowing people to borrow more for those with the higher incomes who can afford it. So that's kind of what's happened, but more is needed in the to actually get people to be able to borrow more. It's restrictive.
And it's particularly bad on the first-time buyer market, isn't it, Phil? First-time buyers are really... This year must have been hell for them, but, it was already bad. And again, we've got, we've been talking about property and demand. And again, there's not necessarily the properties there for first-time buyers. And so the last year must have been quite a challenge for them. And with the cost of living crisis, it's just going to be exacerbated. The rents are going up, there's less chance of saving. It's just so complex for them.
Yeah. First time buyer business has gone down as in line with the market and purchase transactions. So again, I think a lot of first time buyer business is also propped up by bank of mum and dad, either helping them with a larger deposit, usually, or looking at other solutions like things like joint borrow sole proprietor, where a parent can step in and help with affordability. So, but yeah, there's no doubt that's been impacted. So, although house prices have possibly stayed more static, gone up less, or even come down slightly, it's the affordability payments are impacting it. So they're still having to put in more so they can afford payments at higher rates, and that's where we are at the moment.
Ray, as a wider industry perspective, how was the industry done to help first-time buyers? Has there been a focus this year? Have you seen new products coming out? Is there new innovations that you think, oh, okay, somebody stood up and thought, yes, they need a bit of support?
Well, the Skipton is the obvious one. The Skipton's 100% mortgage for renters, which the rate on which they're dropping to 5.89% as from the 31st of October. So 100% mortgage at 5.89% compared with the cheapest 60% LTV 5-year fix, because that's what the Skipton deal is, that's 1.25% cheaper. I think that's a pretty tasty differential between the 60% rate and the 100% rate. So I am a bit surprised no other lender has followed Skipton on that route, because clearly, as long as you've got strict underwriting criteria, bearing in mind that we all know the key thing is affordability. So once you've established affordability, coupled with the fact that nobody expects property prices to fall too far, I think we're going to see property prices gently edge lower for the next 12, 18 months. But the amount you'll pay off your 100% mortgage, bearing in mind it's clearly got to be repayment, will probably pretty well compensate for any drop in property prices. So that's a sort of product which I think is really interesting for first-time buyers. And at John Charcoal, until middle of last year, we found that the split of our purchase business was about 50-50 between movers and first-time buyers. In the latter part of the year, that started to move more to first-time buyers. So although activity has fallen across both first-time buyers and movers, for the last few months, the split's been around, in fact, since early this year, the split's been around 60-40 in favour of first-time buyers. And I think the rationale for that is actually not difficult to understand. if you're a first-time buyer renting, then we all know the challenges of renting. Costs are shooting up, and you're going to compare the different costs, but also the security of tenure you're going to get. 'Cause it's not just a case of paying higher rents. For many people, it's a case of finding a suitable property. So there's an added incentive if you're a first-time buyer, particularly if you're renting rather than living with your parents. Whereas if you're a mover, a couple of years ago, you were perhaps thinking, oh, I can trade up, get a mortgage that's £50,000 or £100,000 more, get a bigger property. Now you're finding if you want to get that bigger mortgage, the extra cost is going to be significant, whereas before it would have been very affordable. So that, I think, is going to put a damper on the mover market for the next year or two until incomes catch up and mortgage rates come down a bit more. Whereas for first-time buyers, those dynamics are still going to be the same. One other suggestion, and this will horrify people in the pensions market, but if we're looking at ways we can help first-time buyers, one thing I would like the government to do is to give potential first-time buyers the opportunity to put the 8% of their money, of their salary that currently has to go into an auto-enrolment pension, give them the option to put that into a LISA. And that would enable them to build up their deposit, and they probably only need to pay into the LISA for 3 or 4 years. Now, the government's just passed an act which is going to reduce the age at which you have to start contributing into an auto-enrolment pension from 22 to 18. And it's also going to mean that you have to contribute, and of course the company has to contribute, your employer, on your whole salary rather than only your salary above about 6,500. So it would be an ideal time, in my view, when these changes take effect, which is expected to be sometime in 2025, for the government to also give people the option to have that money paid into a LISA and to give them the same tax benefits, i.e. that money is paid in out of gross salary rather than net salary. That would be a great boost, particularly for those who haven't got the support of the bank of mum and dad and have got to rely on saving their own deposit. And then they can go back to putting money into their pension, and because they've got their property, they'll be much better off in later life. And they in most cases, I think, will easily be able to make up the shortfall in their pension. So that's something I'd like to see the government do, but we'll see what happens.
Let's hope someone listens, hey? Should we? Maybe I'll just forward on the link to this podcast and have a little listen to Ray's and the ideas. Brilliant stuff. Just on that, actually, this is a good timing. We started talking about it, and I know it's a good chance to bring this in. Really, is to talk about landlords because they are a big part of the market. They are, and Phil, I think it was only a podcast back, or if not 2 podcasts back, where you said there wouldn't be a rental market had it not been for private landlords because we haven't got any social housing. So, landlords do play a huge part in the market, and there's been quite a lot of turmoil or potential turmoil for landlords this year with the introduction legislation, which has now been brought back on. So, the forcing of improved EPC ratings and the removal of Section 21, all looking like they're sitting on the edge of a knife at the moment, and perhaps not happening, at least in the short term. This, Tony, I'll let you come in. You haven't spoken for a while, but just you've really championed buy-to-let and landlords, and this is good news for the landlord, perhaps not so much for the renter, but good news for the landlord. It should hopefully keep that area of the market buoyant, and because there was concern, I think we spoke a few months back saying there's a chance that the buy-to-let market might drop off the shelf a little bit, but actually, this is going to keep it going.
Yeah. I wasn't surprised with the rowing back of that. That was probably one of the least surprising sort of bits of news, that we're going to row back on it because it had been alluded to and hinted. So it wasn't a surprise, but the disappointment that it's just not been replaced with anything else. And that's what concerns me, and that's what I was quite annoyed about, frankly, is that it sort of seemed to be kicking the can down the road. Now, I'm not saying it was a bad thing, because if it was unrealistic that it was going to be achieved by 2025, the pragmatist in me says but it was just annoying that we've sort of kicked the can down the road and not replaced it with anything else. Mm-hmm. for all the criticisms of EPCs, that's all we've got at the moment. So that's sort of where I am. So I've probably contradicted myself with the answer, but that's just how I feel about it.
I feel the same. I feel really conflicted by it because there's so many different elements. This year, we always talk about the state of the housing stock in this country, and this is a way of giving it a kick up the butt and moving it on. And then there's the plight of the landlord, then there's the plight of the renter. Tony, any views on this? Because I know you really have championed buy-to-let. There is some good news in this, but do you think it's going to create or maintain the buoyancy with the buy-to-let market that the government hope it will?
I don't think it will make much difference because I think most landlords weren't doing anything anyway towards the impending regulation. So I don't think it will change that. Obviously, you've got landlords to a degree offloading property, but we're not seeing that as a lender. Our redemptions in buy-to-let and even our remortgaging at maturity is not there because there's not many places for them to go to in order to get, well, A, the hassle, but B, affordability. It's much easier to stay with the lender you're with where you're not going through that affordability hurdle again. So I think it's probably a knee off the neck for the market a little bit, shall we say? But I don't think it will make that much of a difference. But because ICRs are still extremely difficult hurdles to overcome for most, I'm sure the other two can tell us, but there's no money in a single AST anymore for a new landlord. It's very hard to do that. So if you're an existing portfolio, then there's opportunities. If you're looking to become a first-time investor, then it's really hard to see a way forward at the moment in a single AST property, a single household property. You're looking at HMOs, which brings in its own challenges because not many people will lend to somebody who's a first-time landlord, first-time buyer in an HMO. But that's the only way to get a yield that makes the investment possible. So it's challenging, but, all of these... all of this, the market's resilient. It'll find a way to do something to support somewhere. And we just got to keep, for those who are portfolio landlords, they're still kind of doing all right as far as I'm aware. I'm not hearing any wholesale portfolios collapsing, but obviously Ray and Phil might have a different view.
Yeah, we've seen landlords changing their portfolios of property types, so selling some of the more older properties and tending to buy up more new builds, which tended to be more energy efficient. So it'd be interesting to see whether that trend continues or not. That'd be interesting. Then, as obviously Tony said, we're seeing more interest in HMOs, and the other optic that I've heard about more, although we're not specifically in that market, is again holiday lets or short-term lets, more demand for those, and I'm assuming that's due to yield opportunities.
Ray, I don't know if you've got anything to say on that before we move on.
Well, the only thing I'd really add to that is, and I broadly agree with Tony, I think that landlords who might have dismissed the possibility of buying a property that had an EPC rating of less than C now might reconsider it. The 2025 deadline was never set into stone, and it had already been mooted. It will be moved to 2028. But if even 2028 means you're not going to buy a property that would require that, so now that has been taken off the table, I think you might find some buy-to-let landlords who would perhaps be looking at cheaper properties in that DE category that they wouldn't have considered before. So it'll be interesting to see how lenders respond to that, because at the moment, obviously, I'm not sure whether the target's still there, Tony, but lenders did have a target from the government to have a proportion of their mortgage book C rating or above by a certain date. Is that still in place?
I'm not aware. I'd have to check that, to be honest. It's certainly, it's certainly there, but it's not in any project status for us. Put it that way. So it's not an impending deadline. Was it? I can't remember the dates for it. Was it like 2030 or something? We had to an average C rating across the book, wasn't it, Phil? If you remember.
I think so. Yeah. Again, that's something I'd have to check in. It's certainly not anything we're feeling heat over.
No, it's not.
It's
It's
not
not
blind panic
right
thinking
yet,
this is coming up soon. It's obviously not something that's been pushed too hard yet.
Yeah. But we are, as all lenders are, we are looking at how do we correctly gauge our book. Because, in most of the cases, we don't ask the questions. We've got absolutely no idea, if I'm honest, or it's completely out of date. So it's going to be an interesting one. It will be an interesting one.
Just staying with it, because I'm just picking up the topics we talked about last year. So just one of the areas that we talked about, and we do like to talk about quite a lot, Tony, was the self-employed. We talked about how rough it was for them last year and how much they got kicked in the guts after the mini budget. I know as a lender you've done a lot in this area. So let's come to you two first about Saffron and what you've done and what you've seen in the market and why you did it, and then maybe we can go to Ray and find out how the market wide looks for self-employed. But Tony, just for those that might not have heard the previous podcast, might not know what you've done and might not know what your opinions are, how did it affect the self-employed? What did you do to help them?
Well, we've just been a champion of the self-employed, kind of even before the pandemic, really. If we go back that far, it's always been a target category for us to support self-employed owners, business owners. So I think post-pandemic, we were one of the first lenders to discount the pandemic year. So that's probably the first thing we did. And that's old hat. Everybody does that now because we're running out of that 3-year cycle. But no, we helped that so that people weren't panicking about this huge nothing profit scenario. And we started taking final year as standard, which we still do. So if the business is showing a upwards growth trend, we don't automatically average it and take that benefit away from that self-employed business owner that's worked really hard to grow their business. If it's substantial, we'll have a little look and make sure that is sustainable. But that's one way we've done it. We've been an advocate and been in the market for 1 year, self-employed all the time. And we're now, I'm delighted we're at 90% and have a 5-year fixed rate back in that market. So we're very comfortable for those who haven't been trading long as well to support. So, and we've just done a lot of research through using YouGov on the self-employed to understand the challenges that they face. And, I know a lot of lenders have done a lot of analysis on this, but the biggest thing that we saw was the lack of education. And I know we've used that already across financial in general, but our research showed that 8 out of 10 self-employed people who were looking for mortgages didn't believe they could get one, and only over half didn't even know where to start to look for it. So that's got us on an education campaign to look at ourselves as a lender, but also put out there to lenders and brokers, what does your website say about what you do? Because if 3/4 of your audience say that they didn't know they could get a mortgage, all of us need to look at how we explain this, because we're missing huge opportunities to support an area that thinks it's worse off than it is. So that's the kind of big thing that we're doing, just pushing up that education around, if you're self-employed, you can get a mortgage. Generally, obviously, if it's a sustainable business, come and speak to and this is where we say, and Phil's already said it, go and find a professional mortgage advisor, because they will be able to unlock those myths and help you out.
I think the self-employed, for me, the story that stuck out for me was, I can't remember the exact figure, I've been trying to find it. It was something like 37% of products became unaffordable for them at the start of the mini budget last year. So if you've got research saying they didn't think they can get one anyway, you've got stories generated out there saying, look, at least over a third of your products are going to be unaffordable for you anyway. There must have been like an absolute meltdown in the sector of people going, there's just no point after the mini budget. Excuse me. Thanks for that. So, Ray, coming to you, last topic on my list before we do our predictions, and this on later life, something you educated me on a little bit earlier on today. That some rules have been changed to accommodate hybrid products. So maybe you can just, for the brokers in the audience who might not have read up on it yet or might not be aware, just let us know what you found out.
Fine, thanks, Jay. Well, the FCA very recently amended the definition of a RIO mortgage to accommodate hybrid mortgages that some lenders in the lifetime mortgage market want to introduce. So, there are one or two lenders now offering products on a hybrid basis where they start off as a RIO and then revert to a lifetime mortgage at some specified future date. The the rationale for that, from the lender's perspective, is that in the early years, while people are still working, they can afford to pay the interest, and they'd like to encourage them to pay the interest. But recognise that from the customer's point of view, having a guarantee that the mortgage will be there long term, rather than having to repay it when they stop working, has some value. Now, I think that for many customers for whom that mortgage might be available, they will probably be able to get an alternative RIO or even a mainstream mortgage from some of the smaller building societies, for example, who are in that market, and then perhaps look at a later stage to switch into a lifetime mortgage. But the fact remains, it's an interesting example of how lenders in the lifetime mortgage market are trying to develop new products to reflect the fact that clearly their lending volumes have gone down even more than people in the mainstream market. One product in the hybrid space, which I think would in fact be interesting, would be replicating the type of product we have in the mainstream market, where you can do part interest only up to say 50 or 60%, and then part repayment up to maybe 75, 80%. If you had a hybrid mortgage that was part interest only, and part lifetime from day one, then again that would give people another option, and I think there may be some lenders looking at that type of option. So, just really to flag up that if you are a broker that operates in the RIO market, we have got now a revised definition of RIOs, which mean that if you're offering a whole of market proposition, if these products, which are currently only on pilot, come into the whole market, that will be another product people need to be aware of. And we've also got, of course, a couple of lenders, at least Hodge and Livermore, who've got a minimum age of 50 for their later life products. So Livermore in particular have been quite innovative in terms of introducing new products in that space. So for any broker, they're undoubtedly going to have a significant proportion of clients who are age 50 or over. And it does mean that market, one needs to be very aware of, even if most of your clients are still going to be in the mainstream market.
There we go. That was really insightful. Thank you, Ray. And I'm going to have to be the party pooper because we are running out of time. So in our last couple of minutes, we always do this. I've got about 20 more questions written down here. I've been skipping around all over the place trying to get everything in I wanted to. So I'm going to come to you. So we are now going to be November 2024. Where are we going to be? Phil? This is a right on the spot question, yeah? Crystal balls out, guys. You get ready.
I think we'll be in a similar, but rates-wise, I think we'll be in a similar position to where we are today, barring any unexpected world events that we don't know might happen. But that's where I think we'll be.
Tony?
I kind of agree. I think we'll see this. What we'll see is fixed rates largely lower than base rate, which is always odd because you shouldn't have a rate lower than your base rate, but it's the only way to get volume if you're fighting on volume. So I think it'll all depend on what lenders' volume aspirations are for next year in the mainstream as to what happens to the downward pressure on fixed rates. I don't think we'll see any change in base rate. As I said earlier, it might drop a bit, but I think they're going to want to stubbornly get inflation under control before anything else is done. So I think a very similar market. I think house prices are not there. They are slowly deflating to probably an actual norm rather than an inflated high. But I do think lenders are starting to innovate on affordability. So I'd like to think we'll see other innovation around affordability hitting the market in the next 12 months. That's what I'd like to see.
There we go. Ray, will you come back next year and we'll go over it and see how our prediction did this time? Because you predicted the mortgage charter last year, so maybe we'll come back and actually review and see where we all actually sat on that. So on that's it. Ray, thank you again for brilliant insight. Another brilliant podcast. A year on. Do come back in November 2024 and let's do it all again and let's talk about our predictions. Anybody who would like any information on what we've done now, wherever you listen to your podcast, I'll put some links to everyone's LinkedIn so you can send anyone a message privately if you'd like to chat about anything we've talked about. And do keep following the Saffron for Intermediaries LinkedIn page where you can keep up to date on all news, insights and other things where Tony's been punting himself out in the media. Some great stories and commentary darting around there. So do give that a follow. And we will be back with you in December. So that'll be our final one of the year. So from all of us, it's a big thank you. Ray, superb as always. Thank you so much, Tony, Phil. And I'll see you next month.